Financial statement fraud, when the numbers lie with straight faces. Y'all ever notice how companies can lose money for 10 years straight, but their financial statements make them look like the next Apple? In financial statement fraud, the first lie is never on paper, it's in the mirror. I'm Dr. Fulmore. Lock in. The financial fiction mindset. You've seen this movie. You know when you're crafting that perfect Instagram post, choosing just the right filter, the perfect angle, maybe using last year's vacation photos to make your life look better than it is? That's financial statement fraud energy, except instead of fooling your followers, companies are fooling investors. And instead of likes, they're collecting federal indictments. You've been practicing this art of selective presentation your whole digital life. Think about your resume. Proficient in Excel, when you mean you can make a spreadsheet. Leadership experience from being forced to lead a group project. Entrepreneurial spirit from selling your old textbooks online. You're not exactly lying, you're just optimizing the truth. Now imagine that same energy but with billions of dollars and SEC investigators. That's financial statement fraud. LinkedIn profiles for corporations, except the exaggerations lead to handcuffs. To know accounting, you must do accounting. But to understand financial statement fraud, you must understand that numbers don't lie. People make numbers lie. Today we're learning how good accountants become creative writers, how financial statements become financial fiction, and why Crazy Eddie wasn't crazy. He was criminal. Lock in, because we're about to see how the math stops mathing when management starts managing the truth. The foundation. Every number tells a story, some are fiction. Financial statement fraud is the deliberate misrepresentation of a company's financial condition through intentional misstatement or omission. It's not a mistake. It's not aggressive accounting. It's straight up lying with Excel. Think of it like your friend who says they're talking to someone famous, but it's really just liking their TikToks. The intent to deceive is what makes it fraud. The conceptual framework of accounting, those assumptions and principles we learned, they're not suggestions, they're the rules of the game. Economic entity assumption says the business is separate from its owners, but tell that to the CEO using company funds for yacht payments. Going concern assumes the business will continue, but what if it's already dead and management's just weekend at Bernie'sing the corpse? Revenue recognition says record when earned, but Enron recorded revenue from deals that were more hypothetical than your summer body goals. Here's the historical truth that should terrify you. The South Sea Company in 1720 created the template for every financial fraud since. They reported profits from trade routes that didn't exist, assets they didn't own, and future revenues that were pure fantasy. 300 years later, Wirecard did the exact same thing with $2 billion that existed only in spreadsheets. As Warren Buffett says, only when the tide goes out do you discover who's been swimming naked. Financial statement fraud is skinny dipping with shareholder money. Who commits it? The usual suspects with unusual access. The profile of a financial statement fraudster isn't what you'd expect. It's not some sketchy character in a back room. It's the CEO giving keynote speeches about integrity. It's the CFO who volunteers at church. It's senior management in 89% of cases, according to ACCT data. These aren't criminals who became executives. They're executives who became criminals. The call is coming from inside the C-suite. Think about it like your group project dynamics. Who has the power to change the presentation at the last minute? The person with the final edit access. Who can override everyone else's work? The team leader. In financial statement fraud, that's senior management overriding controls like their suggestions. Middle management might execute the fraud, but they're following orders from the top. It's organized crime, but the organization is the corporation itself. The Crazy Eddie case is a masterclass in family fraud. Eddie Antar didn't just commit fraud, he turned it into a family business. His cousin was the CFO. His brother handled the books. His father counted the skimmed cash. It was The Sopranos, but with electronics retail instead of waste management. When the whole family's in on it, Thanksgiving dinner becomes a conspiracy meeting. As criminologist Donald Cressy noted, Trusted persons become trust violators when they conceive of themselves as having a financial problem, which is non-shareable. When the CEO's problem becomes the company's fraud, shareholders become victims. Why they do it? Pressure makes diamonds and criminals. The pressure to commit financial statement fraud comes from every direction, like a group chat when you owe everyone money. Meet analyst expectations or watch your stock tank. Hit loan covenants or face bankruptcy. Make your numbers or lose your bonus that's already spent on a Tesla you can't afford. The pressure isn't subtle, it's suffocating. It's like having 5 finals on the same day and someone offers you the answer key. But here's the psychological twist. Sometimes they understate performance. Cookie jar accounting is saving fake losses today to release as fake profits tomorrow. It's like intentionally failing a quiz early in the semester, so your improvement looks dramatic. Taking a big bath right off is destroying everything at once, so next year looks amazing by comparison. Companies manipulate earnings like Instagram influencers manipulate their follower counts. Whatever makes them look good at the moment. The Stanford Graduate School of Business studied 169 SEC enforcement actions and found that 75% involved meeting or beating analyst expectations by exactly 1 penny. 1 penny. That's not coincidence, that's coordination. As former SEC Chairman Arthur Levitt said, managing may be giving way to manipulation. Integrity may be losing out to illusion. When missing estimates by a penny can tank your stock 20%, that penny becomes worth committing fraud over. Today's price is definitely not yesterday's price, when yesterday's price keeps you out of prison. Accounting principles. The rules they're breaking. Let me break down GAAP, Generally Accepted Accounting Principles, like it's the rules to a game everyone's trying to cheat at. Historical cost says, record assets at what you paid, not what you wish they were worth. But companies treat historical cost like historical fiction, writing whatever story sounds best. Revenue recognition says record when earned, but companies recognize revenue like they recognize celebrities, whenever it's convenient. The matching principle says expenses should match their related revenues. It's like splitting an Uber fairly. Whoever benefited should pay their share. But companies defer expenses like you defer studying, push it to next period, and hope nobody notices. Full disclosure says tell investors everything material. But material becomes subjective, like just talking, in relationships. Everyone has their own definition. The Venetian merchants in the 1400s invented double-entry bookkeeping partly to prevent fraud. Yet here we are 600 years later, and companies are using that same system to commit it. Luca Pacioli, the father of accounting, wrote, "Without order, there is chaos." But some companies prefer chaos because it's easier to hide fraud and confusion than clarity. When WorldCom capitalized $11 billion in operating expenses, they weren't following GAAP. They were gapping between legal and illegal. Fictitious revenues, sales that never happened. Fictitious revenues are the ultimate fake it till you make it. Except you never make it, you just fake it harder. It's like claiming you sold your old textbooks for double what you paid when really they're still under your bed. Companies record sales that never happen to customers who don't exist for products nobody wanted. The revenue is more fictional than your "I'm 5 minutes away" text when you haven't left yet. The 4 criteria for revenue recognition are like the 4 requirements for graduation. Miss one, and it doesn't count. Evidence of arrangement. Did someone actually agree to buy? Delivery occurred. Did they get it? Price is fixed. Do we know how much? And collectability is assured. Will they actually pay? Companies violate these like students violate attendance policies, creatively and hoping nobody notices. Crazy Eddie's revenue fraud was so brazen they were literally making up sales transactions. They'd ship empty boxes to stores, count them as sales, then bring them back. It's like returning something to Target you never bought, but somehow getting store credit. The auditors saw shipping documents, invoices, all the paperwork. What they didn't see was that it was theater. As Sam Antar, Eddie's cousin and CFO, later admitted, "We committed our crimes simply because we could. The incentives were there, the systems were weak, and we were smart enough to exploit them. Timing differences, playing with the calendar. Timing differences are how companies make this quarter look good at next quarter's expense. It's like submitting the same paper for two different classes. Eventually, someone notices and you fail both. Channel stuffing is shipping next period's sales this period, like forcing all your friends to buy Girl Scout cookies in December so you win the January contest. Premature revenue recognition is counting chickens before they hatch, then being surprised when you're short on eggs. Companies manipulate timing like students manipulate deadlines, with creativity and desperation. They'll recognize revenue from contracts still being negotiated, like claiming you got an A on an exam you haven't taken yet. They'll defer expenses to next period, like pushing your credit card payment to next month. It doesn't disappear, it just gets worse. The accounting periods are arbitrary, but the fraud is deliberate. Remember when Groupon tried to invent their own accounting metric called Adjusted Consolidated Segment Operating Income? They literally made up their own rules because GAAP made them look bad. It's like creating your own grading scale, where F means fantastic. The SEC shut that down faster than your parents shut down your house party plans. As Abraham Bryloff, the accounting professor who exposed numerous frauds, said, "More fiction is written in accounting than in literature." Concealed liabilities, hiding the bills. Concealing liabilities is like hiding your credit card statements from your parents. The debt doesn't disappear, you're just postponing the conversation. Companies leave liabilities off the balance sheet like you leave embarrassing photos off Instagram. If investors don't see the debt, maybe it doesn't exist. Spoiler alert, it does, and it's accumulating interest while hidden. The techniques are creative. Don't record the expense at all, like forgetting to tell your roommate they owe for utilities. Capitalize operating expenses, turning monthly costs into assets like claiming your Netflix subscription is an investment in cultural education. Create special purpose entities to hide debt off balance sheet, which is basically having your friend hold your debt so you look financially responsible. Enron had 3,000 of these entities. 3,000. That's not accounting. That's a shell game where everyone loses except management. Here's the modern version. Operating leases used to be off balance sheet, so companies would lease everything to hide debt. It's like saying you don't have car payments because it's a lease. You're still paying, just calling it something else. New accounting standards close this loophole, but companies find new ones faster than TikTok finds new dances. When Lehman Brothers used Repo 105 transactions to temporarily remove debt before quarter end, they were essentially sucking in their financial gut for the photo, then letting it out after. Improper disclosures. The fine print nobody reads. Improper disclosures are like those terms and conditions everyone agrees to, but nobody reads, except in financial statements. They're legally required to be accurate. Companies bury bad news in footnotes like you bury your real feelings in LOL and JK. The footnotes to financial statements are where the bodies are buried, but most investors don't bring shovels. Related party transactions are disclosed like your relationship status on Facebook, vague enough to avoid questions. When the CEO sells buildings to the company he runs at inflated prices, that's not a market transaction, that's self-dealing with documentation. When board members are on both sides of a deal, that's not negotiation, that's coordination. WeWork's Adam Neumann was leasing buildings he owned back to WeWork. He was literally his own landlord and tenant, paying himself with investor money. Malcolm Gladwell talks about thin slicing and Blink, making quick judgments based on limited information. Investors thin slice financial statements, reading headlines, not footnotes. Companies know this and exploit it. They'll disclose fraud risks in language so vague it's meaningless. The company faces various risks is like saying life has challenges. Technically true, completely useless. When Theranos' disclosure said their technology was novel, what they meant was non-existent. Slide 10. Improper asset valuation, making nothing worth something. Improper asset valuation is like listing your 2010 Honda Civic for the price of a Tesla on Facebook Marketplace. Sure, you can ask that price, but that doesn't make it worth it. Companies inflate asset values like college students inflate their GPAs, creatively, and hoping nobody checks the math. When assets are overvalued, the entire balance sheet becomes fiction based on fantasy. Inventory fraud is the classic move. Count inventory that doesn't exist, value obsolete goods at full price, or include inventory you've already sold. It's like counting your roommate's food as yours when calculating your net worth. Crazy Eddie would move the same inventory between stores during counts, like using the same $20 to pay back 5 different friends by moving it between them. The auditors counted boxes, not realizing they were counting the same boxes multiple times. The Goodwill scam is even better. Goodwill is the premium paid above fair value in acquisitions, basically paying extra for vibes. Companies avoid writing down goodwill, even when it's worthless, like keeping your ex's photos on Instagram because deleting them admits the relationship failed. When AOL Time Warner finally wrote down $99 billion in goodwill, they were admitting what everyone knew. They overpaid for a dying business model. That's not an accounting adjustment. That's an admission of failure worth more than the GDP of Ecuador. Crazy Eddie, the case study in family fraud. Let me tell you about Crazy Eddie because this wasn't just fraud, it was performance art with federal implications. Eddie Antar turned a small electronics chain into a fraud machine that would make Bernie Madoff jealous. The tagline was, "His prices are insane." Turns out, so were his accounting methods. This is what happens when the whole family treats the company like a personal piggy bank with shareholders' money. The skimming phase was beautiful in its simplicity. Report less sales, pocket the difference, live tax-free. It's like working for tips, but telling the IRS you're unemployed. But here's where it gets genius-level criminal. When they went public, they reversed the skimming to show growing profits. They literally reported the money they'd been stealing as new growth. That's like returning stuff you shoplifted and claiming you increased store revenue. The inventory inflation was chef's kiss criminal creativity. During audits, they'd ship empty boxes between stores, creating phantom inventory. They'd climb through ceilings to alter count sheets. They'd distract auditors with literal dancing girls. I'm not making this up. They hired women to flirt with auditors during inventory counts. When your audit defense is distraction by attraction, your fraud is probably significant. Eddie went to prison, fled to Israel, got extradited, and served 7 years. His cousin Sam now teaches about fraud. Talk about a career pivot. Vertical analysis, seeing the lies in percentages. Vertical analysis is like looking at your spending as percentages of income instead of dollar amounts. Suddenly that small coffee habit is 15% of your budget. We express everything as a percentage of a base figure, usually total assets or revenues, and see if the proportions make sense. When cost of goods sold is 140% of revenue, the math ain't mathing unless you're running a charity. Think of it like your screen time report. Instagram might only be 2 hours, but if that's 40% of your phone usage, we need to talk. Same with financial statements. If marketing expense is 60% of revenue, either you're Netflix launching globally or you're hiding something in that line item. The percentages tell stories that absolute numbers hide. Tony's Bodega might show sales of $100,000, COGS of $70,000, gross profit of $30,000. That's a 30% margin, which is normal for retail. But if next year shows sales of $150,000, COGS of $80,000, gross profit of $70,000, that's a 47% margin. Unless Tony discovered alchemy, something's wrong. Either he's recognizing fictitious revenues or understating costs. The vertical analysis catches what the raw numbers hide. As forensic accountant Howard Shillett says, financial shenanigans are easiest to spot when you know where to look. Horizontal analysis, catching the trend, lies. Horizontal analysis is tracking changes over time, like comparing your freshman year photos to senior year. The differences tell the story. We calculate percentage changes between periods and look for anomalies. Revenue growing 50% while the industry shrinks. Sus. Expenses dropping while operations expand. The math ain't mathing. It's like tracking your friends' relationships through their Instagram posts. Sudden decrease in couple photos, something's up. Sudden increase in gym selfies, they're single. Financial statements work the same way. Accounts receivable growing faster than sales, they're stuffing the channel or recognizing fake revenue. Inventory growing while sales decline, they're either terrible at forecasting or inflating assets. When Luckin Coffee showed same-store sales growth of 90%, while Starbucks struggled to hit 3%, that wasn't Chinese innovation, that was fabrication. The horizontal analysis showed impossible growth in a mature market. It's like claiming you went from bench warmer to NBA starter in one season. Technically possible, statistically improbable. When the numbers violate common sense is usually right. Ratio analysis, the relationships that reveal. Ratios are like relationship dynamics. They show how different parts interact. Current ratio, current assets divided by current liabilities, shows if you can pay your bills, like checking if you have enough in checking to cover your credit card autopay. Quick ratio removes inventory because you can't pay bills with unsold merch, like realizing your Supreme collection won't cover rent. The efficiency ratios are particularly revealing. Inventory turnover shows how fast you sell stuff. If Apple's inventory turns 365 times a year, but your electronics store turns 4 times, you're not Apple, you're struggling. Days sales outstanding shows how long it takes to collect payment. If it's growing, either your customers are broke or your sales are fake. It's like the time between I'll Venmo you and actually getting Venmo'd. The longer it takes, the less likely it's real. The DuPont analysis breaks return on equity into components like breaking down your GPA by class. Is your high ROE from operational efficiency? Good. Leverage? Risky. Or accounting manipulation? Illegal. When Valent showed 60% ROE, the DuPont analysis revealed it wasn't operational excellence. It was massive leverage and aggressive accounting. As Warren Buffett noted, when management with a reputation for brilliance tackles a business with a reputation for bad economics, the reputation of the business remains intact. Cash flow analysis, where fiction meets reality. Cash flow is where the lies go to die. You can manipulate earnings with accruals, but cash is cash. It's like your bank balance versus your calculated balance. One is real, one is hopeful. When reported profits consistently exceed operating cash flow, that's not success, that's suspicious. The gap between net income and cash flow is where fraud hides. Think about it like your budgeting app versus your actual bank account. The app says you saved $500 this month, but your bank account went down. Where's the disconnect? Same with companies. Enron reported billions in profits while burning cash. WorldCom showed earnings growth while cash evaporated. If you're profitable but can't pay bills, you're not profitable. You're practicing fiction. The quality of earnings ratio, operating cash flow / net income, should be around 1. If it's consistently below, earnings are low quality, possibly fraudulent. It's like Instagram followers versus engagement. Lots of followers mean nothing if nobody's actually interacting. When Amazon shows negative earnings but positive cash flow, that's strategic reinvestment. When WeWork shows positive earnings but negative cash flow, that's creative accounting. The difference? One builds warehouses, the other builds fantasies. Non-financial metrics, the reality check. Non-financial metrics are like checking someone's tagged photos versus their posted photos. One they control, one they don't. Companies report financial metrics they can manipulate, but non-financial metrics often tell the truth. Store count, employee numbers, production capacity. These are harder to fake than revenue. If a company claims 50% revenue growth but store count is flat, where's the growth coming from? Same-store sales better be incredible or something suspicious. It's like claiming you doubled your friend group, but your Instagram followers didn't change. The math needs to match the reality. When Luckin Coffee claimed 4,500 stores, but physical count showed 3,000, that wasn't a rounding error, that was fraud. Under Armour got caught stuffing the channel. shipping next quarter's orders early to hit targets. The financial statements showed growth, but non-financial metrics revealed the truth. Same retailers, same shelf space, just different timing. It's like claiming you're more popular because you posted all your photos at once instead of spreading them out. The content didn't change, just the timing. As Peter Drucker said, what gets measured gets managed, but what gets managed can get manipulated. Wirecard, the modern masterclass in missing billions. Wirecard makes Crazy Eddie look like amateur hour. This German payment processor claimed to have 1.9 billion euros in Philippine banks. Spoiler, the money didn't exist, and neither did the bank confirmations. This is financial statement fraud in the digital age, global, complex, and hidden behind technology buzzwords. When auditors finally checked, the trustee literally said, "No such account exists." That's not an accounting error, that's 2 billion euros of fiction. The red flags were everywhere, but nobody wanted to see them. Margins twice the industry average, German efficiency, acquisitions with no due diligence, aggressive growth, whistleblowers and journalists attacked, short sellers spreading lies. When the Financial Times investigated, Wirecard sued them and got German regulators to investigate the journalists instead of the company. That's not defense, that's offensive fraud. Here's the kicker. EY audited them for 10 years and never verified the cash. 10 years. That's not auditing, that's enablement. They relied on third-party confirmations that were forged, screenshots that were doctored, and explanations that made no sense. When your auditor doesn't verify your largest asset for a decade, they're not auditing, they're participating. The CEO went from billionaire to fugitive, currently hiding somewhere with a new identity. The lesson? In financial statement fraud, it's giving international incident. Detection techniques? Becoming a numbers detective? Detection is about pattern recognition, like knowing when your friend is lying about why they can't hang out. The numbers have tells just like people. Earnings grow smoothly while cash flow is volatile. That's earnings management, accounts receivable growing faster than sales, channel stuffing or fictitious revenues, gross margins improving while competition increases. Either you're Apple or you're lying. Benford's law is the forensic accountant's secret weapon. In naturally occurring numbers, about 30% start with 1, 18% with 2, down to 4.6% with 9. When financial data violates this pattern, it's often manipulated. It's like how real social media engagement follows patterns, but bot followers don't. The math of nature applies to financial statements too. When GE's numbers violated Benford's law, investigators found $38 billion in fraud. The Benish M-score predicts earnings manipulation using 8 variables. Score above minus 2.22. High probability of fraud. It's like a credit score, but for corporate honesty. The score caught Enron before the collapse, flagged Valent during its peak, and identified Wirecard years before the scandal. But here's the problem. Companies know about these tests now. Modern fraudsters run their fake numbers through detection algorithms before releasing them. It's an arms race where both sides have calculators. The psychology of financial statement fraud. The psychology is fascinating because it's not sudden moral collapse, it's gradual ethical erosion. It starts with small adjustments. We'll make it up next quarter, then bigger ones. This is just timing, then fraud. Everyone does this. The rationalization evolves from exception to rule. It's like your exercise routine. Starts with just today, becomes just this week, ends with what exercise routine. Stanford's research on executive psychology shows fraudsters score high on charisma, but low on humility. They're narcissistic enough to believe they won't get caught, optimistic enough to think they can fix it later. They view rules as suggestions and themselves as exceptions. When Bernie Ebbers of WorldCom said he didn't know about the fraud, he wasn't lying. In his mind, aggressive accounting wasn't fraud, it was leadership. The dark triad of personality traits, narcissism, Machiavellianism, and psychopathy, appears more frequently in financial fraudsters than general population. These aren't criminals who became executives. They're executives whose personality traits enable crime. As Robert Hare, creator of the psychopathy checklist, noted, not all psychopaths are in prison, some are in the boardroom. When your CEO shows these traits, your financial statements might be showing fiction. Deterrence. Stopping fraud before it starts. Deterrence is about making honesty easier than fraud. It's like those mirrors in the self-checkout. You could steal, but seeing yourself makes you reconsider. The three-pronged approach. Reduce pressure, realistic targets, reduce opportunity, strong controls, reduce rationalization, ethical culture. It's not foolproof, but it's fool-resistant. Reducing pressure means setting achievable targets. When you demand 20% growth in a 2% market, you're demanding fraud. It's like requiring a 4.0 GPA in engineering. Possible, but people will cheat to achieve it. Netflix missed earnings estimates, and their stock rose because they were honest about challenges. Meanwhile, companies that always beat by exactly 1 penny. The SEC is watching. The tone at the top matters more than any control. When leadership cuts corners, everyone notices. When the CEO flies private while preaching cost-cutting, the message is clear. Rules are flexible. It's like professors who ban phones but text during class. The policy becomes a joke. As the Association of Certified Fraud Examiners found, organizations with strong ethical culture have 40% lower fraud losses. Culture isn't just soft stuff. It's fraud prevention. Internal controls, the locks on the doors. Internal controls are like two-factor authentication for your money. Annoying but necessary. Segregation of duties means no one person controls everything. The person who approves purchases shouldn't make them. The person who receives goods shouldn't pay for them. It's like requiring 2 keys to launch missiles, except we're preventing financial fraud, not nuclear war. But here's the reality. 95% of financial statement fraud involves CEO or CFO override of controls. Controls are speed bumps, not roadblocks, when leadership wants to commit fraud. It's like having the world's best security system but giving the burglar the code. When management can override any control, the control doesn't control anything. The solution? Board oversight that actually oversees, audit committees that actually audit, whistleblower hotlines that actually protect whistleblowers. Most boards are buddies of the CEO who meet quarterly for rubber stamping. That's not oversight, that's overlooking. When Enron's audit committee waived conflict of interest policies for the CFO, they weren't governing, they were enabling. As former SEC Chairman William Donaldson said, the board of directors is supposed to be the shareholders' watchdog, not management's lapdog. The role of auditors, the watchers who didn't watch. Auditors are supposed to be the financial statement police, but too often they're more like mall security, present but not preventing. The Big Four audit 99% of the S&P 500, creating oligopoly dynamics where keeping clients matters more than catching fraud. When your auditor makes more from consulting than auditing, whose interests are they protecting? Arthur Andersen died for Enron's sins, but did auditing improve? PwC missed Wirecard, EY missed Lehman, Deloitte missed Adelphia, KPMG missed Madoff feeder funds. These aren't mistakes, they're systematic failures. When auditors rely on management representations instead of verification, they're not auditing, they're transcribing. It's like grading papers based on what students say they wrote rather than reading them. The expectation gap is real. Investors think auditors detect fraud. Auditors say they verify compliance. The result? Nobody catches fraud until it explodes. When Markopoulos handed the SEC a detailed analysis of Madoff's fraud, and they ignored it for 8 years, that wasn't oversight, that was willful blindness. As Jim Chanos, who exposed Enron, says, the purpose of auditing is to verify, not to take management's word for it. Analytical red flags, the patterns that predict. Red flags cluster like symptoms of disease. One might be nothing, several suggest sickness. Earnings quality deteriorating, yellow flag, CFO turnover, orange flag, auditor resignation, red flag, all 3. It's giving bankruptcy. The patterns are predictable because fraud follows human behavior. and humans are predictably greedy. The CRIME acronym helps remember key flags: complexity, unnecessary complicated structures; related parties, insider deals; incentives, pressure to perform; management, dominant personalities; and external pressures, debt covenants, competition. When multiple crime factors appear, actual crime often follows. It's like relationship red flags. One might be a quirk, 5 is a problem. Watch for lifestyle inflation in executives. When the CFO, making $500,000, drives a Bugatti, the math ain't mathing unless fraud is funding it. When management's lifestyle exceeds their legitimate income, shareholders are probably funding the difference. Bernie Madoff's lifestyle was a red flag wearing other red flags. As Al Capone learned, it's not the crime that gets you, it's the spending. Technology and fraud. The digital arms race. Technology both enables and detects fraud in equal measure. Blockchain promises immutable ledgers, but crypto enables untraceable payments. AI can detect patterns humans miss, but deepfakes can create evidence that doesn't exist. Every technological advance in detection creates advancement in deception. It's an arms race where both sides have Silicon Valley. Modern fraudsters use technology like students use Grammarly to make their lies look legitimate. They run fake numbers through Benford's law validators. They use AI to generate realistic financial patterns. They create digital evidence that passes initial scrutiny. When forensic accountants use software to detect fraud, fraudsters use the same software to avoid detection. But technology leaves trails. Every edit has metadata. Every transaction has timestamps. Every communication leaves digital DNA. When the FBI recovered deleted texts from Enron executives, technology that enabled fraud became evidence of it. As Mark Andreessen says, software is eating the world. And that includes eating financial fraudsters who think they're smarter than the system. International fraud, when borders don't matter. Financial statement fraud has gone global like everything else. Different accounting standards, GAAP versus IFRS, create arbitrage opportunities. Weak enforcement in certain jurisdictions creates safe harbors. Shell companies in Caribbean islands hide ownership and money. When fraud crosses borders, prosecution gets complicated. It's like trying to return something bought online from a sketchy international website. Good luck. China's fraud is particularly interesting. Luckin Coffee, TAL Education, IQIYI, billion-dollar frauds hidden behind cultural and language barriers. The playbook is consistent. Show impossible growth, raise U.S. capital, cook books until caught. When caught, claim cultural misunderstanding or blame short sellers. The Chinese government's response? Sometimes prosecution, sometimes protection. Its giving geopolitical incident, the convergence of accounting standards was supposed to reduce fraud opportunities. Instead, it created sophisticated fraudsters who know multiple systems. They arbitrage differences, like crypto traders, arbitrage, exchanges. When Steinhoff's fraud involved 100-plus subsidiaries across 30-plus countries, unraveling it required international cooperation that barely exists. As Thomas Friedman wrote, the world is flat, and so is the playing field for financial fraud. Prevention culture, making honesty the easy choice. Culture eats strategy for breakfast, and it digests financial controls for dessert. You can have perfect policies, but if the culture rewards results regardless of methods, you're building a fraud factory. It's like having strict academic integrity policies, while grading on a curve that fails half the class. You're incentivizing cheating while prohibiting it. The Wells Fargo account fraud scandal shows what happens when culture goes toxic. Impossible sales targets, 8 is great, 8 products per customer, created pressure. Threats of termination created fear. Lack of oversight created opportunity. Result, 3.5 million fake accounts. The executives who created the pressure kept their bonuses, while 5,300 employees got fired. That's not accountability. That's scapegoating. Creating ethical culture requires consistent actions, not just words. When Johnson & Johnson pulled Tylenol during the poisoning crisis, Losing $100 million to protect consumers, they demonstrated values. When Boeing kept the 737 MAX flying despite safety concerns to protect profits, they demonstrated different values. Guess which company has more fraud? As management guru Jim Collins writes, greatness is not a function of circumstance. Greatness is largely a matter of conscious choice. The cost of fraud, more than money. The cost of financial statement fraud transcends dollars. Enron's collapse eliminated $74 billion in shareholder value and 20,000 jobs. But the real cost was trust. Arthur Andersen, a 90-year-old firm, disappeared overnight. Sarbanes-Oxley added billions in compliance costs to every public company. One company's fraud became every company's burden. The human cost is staggering. Enron employees lost $2 billion in retirement funds while executives cashed out. Suicide rates spike after fraud revelations. Families dissolve, careers end. When Madoff's fraud collapsed, his son committed suicide on the 2-year anniversary of his arrest. The ripples spread far beyond financial statements. The systemic cost might be highest. When investors lose trust in financial statements, capital markets fail. Cost of capital increases. Economic growth slows. Innovation suffers because funding disappears. The 2008 financial crisis, rooted in fraudulent mortgage representations, cost $22 trillion globally. That's not just a recession, that's economic destruction. As Paul Volcker said, trust is the most important asset in the financial system, and once lost, it's the hardest to recover. Famous last words. Quotes before prison. The last words of financial fraudsters before conviction are a masterclass in delusion. Ken Lay, I am absolutely innocent. Jeff Skilling, I'm immensely proud of what we built at Enron. Bernie Ebbers, I wasn't aware of any improper accounting. Elizabeth Holmes, this is what happens when you work to change things. They're not confessing, they're convincing themselves. The progression from confidence to conviction is predictable. First, denial. The shorts are lying. Then deflection. Everyone does this. Then minimization. It's just aggressive accounting. Finally, blame. I was betrayed by subordinates. They never admit guilt until sentencing, when admission might reduce prison time. Even then, it's qualified. I take responsibility, but my favorite is Barry Minko of Z Best, who went to prison for fraud, got out, became a fraud investigator and pastor, then went back to prison for fraud. When asked about his repeat offense, he said, I thought I was smarter. That's the fraudster's fatal flaw. They always think they're smarter than the system. Spoiler alert, the system keeps receipts. Integration, the complete fraud picture. Financial statement fraud is a system, not isolated acts. Fictitious revenues require false receivables. False receivables require lapping or write-offs. Write-offs require explanations. Explanations require more lies. It's like lying about where you were last night. Each lie requires supporting lies until you can't remember what's true. The fraud becomes a full-time job maintaining fiction. The pattern is consistent across cultures, companies, and centuries. Pressure creates motivation. Opportunity enables action. Rationalization permits conscience. Whether it's the Medici Bank in 1494 or Wirecard in 2020, the formula remains. Human greed plus weak oversight equals fraud. Technology changes methods, not motivations. Understanding financial statement fraud isn't about becoming cynical, it's about becoming sophisticated. Every number tells a story, but not all stories are true. Your job is distinguishing fiction from fact, fraud from aggressive accounting, criminals from aggressive managers. Because in financial reporting, the difference between prison and promotion can be one journal entry. Your role, guardian of truth. After 30 slides, you understand that financial statement fraud isn't just about numbers, it's about narratives. Companies don't just report results, they craft stories. Some stories are true, some are fiction, and your job is knowing the difference. You've learned to read between the lines, behind the numbers, beyond the headlines. You now possess the tools to detect deception. Vertical analysis reveals proportions. Horizontal analysis exposes trends. Ratio analysis uncovers relationships. Cash flow analysis finds facts. When combined, these tools turn you from reader to investigator, from student to guardian. You're not just learning accounting, you're learning accountability. To know accounting, you must do accounting. To detect fraud, you must think like both fraudster and investigator. Understanding how fraud happens helps prevent it. Knowing why it happens helps predict it. Recognizing when it's happening helps stop it. You're not just protecting numbers, you're protecting people's retirements, jobs, and trust in the system. The career proposition, your professional future. Let me paint you the career picture in forensic accounting and fraud examination. While your classmates fight for generic analyst positions, forensic accountants are being recruited like tech talent. The average salary for a certified fraud examiner, $90,000 starting, $150,000 plus with experience. The demand, growing 18% annually. Every financial scandal creates more jobs for people who can prevent the next one. Think about the opportunities. The Big Four have massive forensic practices. The FBI recruits accounting majors aggressively. Their motto is, "It's not accounting, it's accounting for justice." The SEC pays six-figure salaries plus bonuses for catching fraud. Whistleblowers who expose fraud, they can receive 10 to 30% of recovered funds. One whistleblower got $104 million for exposing tax fraud. That's not a career, that's a lottery ticket for doing the right thing. The intellectual satisfaction is unmatched. You're not preparing tax returns or processing invoices. You're solving puzzles worth billions. You're catching criminals with spreadsheets. You're the detective, where the weapon is Excel, and the crime scene is financial statements. Every case is different. Every fraud teaches something new. Every catch saves retirements, jobs, and trust. Here's the economic reality. Fraud is recession-proof because recessions create more fraud. When times are good, companies commit fraud to look better. When times are bad, they commit fraud to survive. Your expertise is valuable in every economic cycle. While automation threatens routine accounting, it creates more need for humans who can detect when AI is being used to commit fraud. The global nature adds excitement. International fraud cases mean international travel. Understanding multiple accounting standards makes you valuable worldwide. Speaking the language of fraud is universal. Whether you're investigating in New York or Shanghai, the math either maths or it doesn't. You could be another accountant preparing financial statements, or you could be the one determining if those statements are fiction. You could process transactions, or you could investigate them. You could trust the numbers, or you could verify them. In a world where financial statements are increasingly fictional, those who can find facts become invaluable. Lock in. Your future is calling, and it's saying, the numbers don't add up. Today, we've decoded financial statement fraud from fictitious revenues to hidden liabilities, from Crazy Eddie to Wirecard, from detection techniques to prevention strategies. You've learned that fraud isn't just about bad people, it's about bad systems that enable good people to make bad choices. You now understand that every financial statement is a story, and like any story, it can be fiction. Your job is to be the fact checker, the myth buster, the guardian of truth in a world of numerical narratives. You have the tools, the knowledge, and hopefully the motivation to make a difference. Remember, in financial statement fraud, the first lie is never on paper. It's in the mirror. The executives who commit fraud convince themselves before they convince investors. Your role is to break that delusion with data, analysis, and unrelenting skepticism balanced with professional judgment. The math will math if you make it. The truth will surface if you dig for it. The fraud will fail if you catch it. That's your job now. That's your power. That's your future. Dr. Fulmore out. Stay skeptical. Trust, but verify. Make the math math. Lock in. The world needs truth tellers.